The simple fact is that bond yields in the US have just fallen more than in other countries in the developed world on hopes that the Federal Reserve would not only start its easing cycle in September, but also follow up with significant easing over the next, let's say, 12 to 18 months. And Jerome Powell has, I think, clearly shifted his focus to the labor market, which has become the primary, I would say, determinant of future policy compared to the first half of 2024, in which inflation has been more market moving.
This is Converge, a podcast from Convera. Come with us as we shape the future of finance. Welcome back to another Converge Market Update. It is August 28th, nearing the end of summer. Hard to believe it. Boris Kovacevic, welcome back. Boris, rate cuts are back on the table, and it seems that investors are rightly or wrongly shunning the US dollar because of it. The Greenback is on track to fall for the second straight month and has lost pretty much all of its 2024 gains. So what do you make of this? And would you say that that's the biggest market story right now?
Yeah, hi Alex. Always a pleasure to be back. I think it is probably the most important story if we include the central bank divergence theme into the weaker dollar narrative. Because let's keep in mind that we are still living in this monetary policy dominated world, meaning that central banks continue to drive the market narrative, and interest rate differentials are still the most useful tool to explain the majority of FX moves we've seen, at least over the last couple of weeks, including, as you mentioned, why the US dollar is down around 5% in the second half of the year so far. The simple fact is that bond yields in the US have just fallen more than in other countries in the developed world on hopes that the Federal Reserve would not only start its easing cycle in September, but also follow up with significant easing over the next, let's say, 12 to 18 months. And Jerome Powell has, I think, clearly shifted his focus to the labor market, which has become the primary, I would say, determinant of future policy compared to the first half of 2024, in which inflation has been more market moving. And the crux of the matter is that the labor market has been weakening very consistently over, let's say, the last couple of months or so.
I think this also ties nicely into the narrative that you explained following the surprise volatility shock on August 5th, namely that markets overreacted to one negative US job print, but that some parts of the shock will have a lasting impact. Is that the case for the dollar and FX more broadly?
Yeah, absolutely, Alex. I think investors seem to have all but forgotten the volatility shock from 3 weeks ago. Global equity benchmarks, for example, are approaching their previous highs. Volatility indicators have almost completely retraced back to their level before August 5th, and bond yields are trading about the same level they did before the weak job report. But as you mentioned, I think some things have permanently changed, one of them being sentiment and this perception that, okay, while markets did probably overreact to the job report, the volatility spike that we have seen should be enough to spook the Fed into an easing cycle, even if the job numbers, let's say next month, improve a little bit. And this is why the dollar, as I said, continues to be in a free fall against most currencies, but in particular the yen, the pound, and the euro. So euro dollar, the most traded currency pair in the world, briefly traded above the 112 mark for the first time this year, and pound dollar broke well through the 130 level, and dollar yen is down around 11% since peaking in July. So really important signals we are getting from the FX markets.
Yeah, levels we haven't seen in quite a while for sure. And this, of course, comes with opportunities and risks for companies and investors hedging their foreign exchange exposure. So in that context, is the carry trade that dominated a good part of the last 2 years over? And it would be interesting if you could give us an overview of the current FX positioning as well, if you don't mind.
Sure. So it is an interesting topic at the moment because of how much position unwinding has happened over the past month or so. So overall, investors remain net long the US dollar, but this is mainly a function of their large negative positioning on the Canadian dollar. If we look more closely at individual currency pairs, speculators are net long the euro, the pound, and the yen versus the greenback. And one thing to note is that the sharp unwinding of these short yen positions since July, right? So not only was it the fastest cutting of short bets on record, investors are now, as I said before, betting on the yen for the first time since early 2021.
So, hearing that, I think the logical follow-up question for our listeners would be, why those three currencies? Why are the euro, pound, and yen so special that speculators are net long on them versus the dollar?
So the euro, yen, and pound, as you mentioned, are the second, third, and the fourth most traded currency pairs in the world, with the dollar on top of that list. So one argument you could make is investors are currently paying a premium, so to speak, to hold these liquid currencies. I think it has more to do with the monetary policy divergence theme I mentioned at the beginning of the podcast, because as we established, the Fed is expected to start its easing cycle in September, and around 100 basis points are priced in for the remainder of the year in terms of easing. So that is the monetary backdrop behind the dollar and its weakness. And then you have to ask yourself, okay, are those other central banks following suit, or are they diverging from the Fed? And the Bank of Japan, for example, has raised interest rates 2 times this year, and another hike might be coming before year end. So this is already, as you can imagine, it works against the dollar's favor. If the Fed is cutting interest rates, if the Bank of Japan is expected to raise them, this is a net negative for the dollar. In the case of the Bank of England, I think it's not as drastic, but even here, the BOE is expected to cut much less aggressive than the Fed. And economic data has been surprisingly solid over the past couple of weeks for the United Kingdom, leaving these long bets on the pound elevated. With the euro, I think it's a bit of a different story. I think it mostly boils down to euro dollar having been quite suppressed for some time and potentially a bit undervalued. So it is dragged higher just by the virtue of the dollar being weaker.
So it sounds a bit like you are not as supportive of a higher euro like you are with the rise of the pound and the yen, or am I mistaken?
Yeah, that is right. I think it's important to mention that we have been pointing to these upside risks on euro dollar 3 months ago when we were trading around the mid 107 level. And I thought that the high 110 area would be a fitting place for the pair to stabilize, just given the current rate differential and all these other leading indicators. But as you know, as I mentioned, we broke through the 111 mark. We shortly traded at 112. And I think the totality of the data does support or gives policymakers continued confidence to lower interest rates, which is a net positive for risk assets and for the euro. But when we look at the cross-asset pricing, we do believe that the US markets place a really low recession probability, but high policy easing probability over the next, let's say, 6 to 9 months. And this Goldilocks assumption of a soft landing coming, but accompanied by policy easing, is only really seen as, I would say, a bit of a contradiction. And for us, it's important to know that one of those would have to be repriced. Either we get a soft landing, but investors have to pare back their expectation of policy easing, or we get a hard landing, we get a recession in the US, and these policy easing bets are justified. So in either case, we would have to have a repricing, which would be negative for the euro. And needless to say, the European macro front and kind of the news flow has not really been supportive of the euro either. We had economic recovery stalling in Germany, and Europe's largest economy is pretty much stuck in a stagnationary period. So we don't see euro dollar trading, let's say, above 112 in the coming weeks and coming months, because the news flow has just been as weak in Europe and Germany as a whole. The only thing I would say, the only way for another leg higher in the currency pair would be for markets to reprice US recession risks higher, given that, as I said, not much room is left to price in more policy easing from the Fed at this point.
Applied recession probabilities are low, you said. Investors once again see a 25 basis point cut as the more likely outcome for the September meeting. Is a larger 50 basis point cut still on the table, in your opinion?
It is an outcome, I would say, that the FOMC, but especially Jerome Powell, are taking into consideration. And to narrow it down a bit, I think the decision will be made by just one singular data point, namely the upcoming job report next week on Friday. And we already discussed last time, I think, how the labor market has replaced these inflation figures as the main driver of Fed policy. But I think the employment rates if it rises even by, let's say, 10 basis points to 4.4%, I think that would be enough to increase the odds of a 50 basis point cut. So despite the next FOMC meeting being on the 18th of September, all the data needed to make the decision will be pretty much out already next week.
Interesting. So we'll definitely want to watch out for the data next week to confirm how likely this large rate cut from the Fed is. Switching it up a bit and moving over to Asia, you've published an insightful piece on the Japan-China divergence this week. Can you give us the summary of why you think this might be important for our listeners?
Yeah, I'll be happy to, Alex. So the basic idea behind the Asia divergence narrative is that China has outperformed, or that Japan has outperformed China, both in terms of economic growth compared to the respective trend, but also in terms of equity outperformance. So foreign investors have noted this reflation of the Japanese economy, with wages rising for the first time in many years, stronger pricing power in terms of the company front, but also higher prices. And on the other side, you also have the normalization of this ultra easy monetary policy that is seen as an attempt to escape the deflationary cycle that pretty much destined Japan and its assets to underperform the Western peers. This is kind of the Japan story. On the other hand, China is currently heading into the completely opposite direction. They're experiencing low inflation rates, falling home and equity prices, and this overall mistrust from institutional money managers abroad. So it seems that the pandemic really changed the perception towards China, because 2019 was the last year in which Chinese equities experienced a net inflow of foreign capital. All following 5 years, including 2024, it seems, have seen capital moving out of onshore stock markets in China. And this is, I think, a good example if you compare it to Japan, where foreign direct investment continues to trend higher, where equity inflows from foreign investors are rising as well, where there is interest into investing into the country in general. And all these factors can quite nicely explain why Japan's equity benchmark has outperformed China's by the most since around 2007. The interesting thing about this, though, is that hearing this divergence favoring Japan, you would usually think that the Japanese yen would have outperformed the Chinese yuan by a large margin, but it's actually the opposite. The yuan is at the highest level against the Japanese yen in more than 20 years, despite the equity weakness, despite bond yields favoring the yen the most since 2010. And this came to a surprise to quite a lot of investors that China has been underperforming Japan in terms of growth, in terms of its equity performance, but the Chinese yuan has outperformed the Japanese yen at such a strong extent. And this is, I think, something of a story that could potentially change going into 2025, and that could be one of the themes to watch out for in the coming months.
Solid breakdown. Thank you, Boris. Always good to have you, and we'll chat again in 2 weeks. Take care.
Awesome. Thanks, Alex. Always a pleasure.